What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. We're going to have a lot of fun again with Dave Ramsey, just breaking down another awful video about him talking about infinite banking being a scam, how he hates dividend paying whole life insurance, whatnot. And here's the thing. I don't really care if people are not a fan of infinite banking, if it doesn't work for you, if you're not a fan of whole life insurance, whatever. My problem comes from people like when people like Dave Ramsey and other influencers deliberately lie about whole life insurance to make their product sound better, to make the sale. And they're providing wrong, inaccurate information, just straight up false information about a specific product to create a narrative where their product is better. How is that helping people? How is that not screwing people over? How does that help them make the best decisions for themselves, for their goals, their situation, their families? It doesn't. You're misleading people and ultimately leading them down a path that's going to encourage them to make decisions that might not actually be in their best interest, that might not be good for them based on your wrong information. That's what really gets to me. It's why one of the reasons I started this channel is to help you guys cut through that BS. So in this video, I'm just going to address a lot of the really stupid things that Dave Ramsey says so that at the end of the day, whether infinite banking makes sense for you or not, you have all the facts and information to make that decision, to make the right decision for you. So me personally, this is just the journey I went down, guys. And, infinite banking didn't make sense like right off the bat, or at least how to implement it, with dividend paying whole life insurance. But as I started to do my research, I got the facts, I listened to both sides, and I compared the data. Well, infinite banking with dividend paying whole life insurance became an absolutely no-brainer to me. Now, it might not for you, and that's fine. But for my goals and my current financial situation, I was just like, sign me up. As soon as I understood exactly how it worked, it just made sense for me. But I only came to that conclusion because I did my research. I listened to both sides, and the other side was just completely full of it, in my opinion. Like when I actually started to look at how these things work and the facts and mechanics of how they work, it's like, okay, I see what's going on here. This actually does make sense. So let's get into it. Let me share my screen and let's have some fun.
Hi, Carl. How are you?
Better than I deserve. How can I help?
Well, I had a question for you. I've been working with a financial advisor who's given me some advice, and I follow the show. I'm on baby step 7 currently. But he presented me with an idea that was a little outside the box. And I have term life insurance. I've been anti-whole life. But he presented me with this infinite banking concept.
Jesus, you're kidding me.
Yeah,
I love his reaction too. It's pretty funny to me, and that I can actually relate to a little bit because I get the same. I kind of have the same reaction when I hear people say that they've been pitched an IUL or they just bought an IUL. Because as you guys know by now, I am not a fan of index universal life insurance at all. Not saying it can't ever work and that it might not be right for some people, but a lot of the times, again, when you learn the mechanics of how these things work, you tend to run away from IUL. And you go to dividend paying whole life insurance. At least that's what I did. So I understand that reaction. Problem is, with the infinite banking concept, he's going to share some really, really dumb stuff. And that's what we're going to break down. So anyways.
Excess money in a savings account and looking to rebalance my portfolio to get it to work a little bit harder. Wow. But my risk tolerance is a little bit low. And he showed me how you can do this where you overfund the whole life policy. Yeah. You can access the money. You break even in year 7, and then the dividend outruns what you put into it.
Yeah,
it doesn't seem like a terrible idea in that regard, but I just wanted your take on why that might not be the best way to go.
The problem is that where it gets confusing is that God, he's selling a dividend. A financial advisor? This is an insurance guy.
Well,
So I don't really understand the significance of that, whether it's a financial advisor, insurance broker, or both. I don't think that really matters. The point is that this person, this advisor, broker, agent, whoever, was presenting an idea, a concept that he thought might be good for this particular gentleman based on his risk tolerance. And if you have a low risk tolerance, the infinite banking concept with a dividend paying whole life insurance policy can absolutely make sense for you, because I tend to have a pretty low risk tolerance as well, especially with like the money that I'm saving and just the foundation that I'm trying to build. And then I utilize my policy to make other alternative investments, and that's fine. Those are a lot more risks that I can control versus just riding the ups and downs of the market. It's just not. It doesn't make sense for me. Again, not that it's bad, but again, knowing what your options are and then getting the facts about how those options work so that you can make the best decision for you is what's really important. Unfortunately, this gentleman is calling somebody who has a terrible bias to infinite banking and whole life insurance. So he's absolutely asking the wrong person, unfortunately.
He's both. They have, it's one of the bigger companies.
Like Northwestern Mutual or Prudential.
Exactly.
Yeah. Okay. He's an insurance guy. He's not a financial advisor.
Okay. Doesn't matter.
So, because those are both mutual companies. Now, there are two types of life insurance companies: mutual and stock. Okay. Likely, you bought your term unless you bought it from him, from a stock company. A stock company, stockholders own the insurance company. A mutual company, which is Pru and Northwestern, State Farm is mutual, is the policy holders are actually the stockholders. Okay.
Okay. Yep.
So when the company makes a profit, the policyholders receive a dividend as if they were a stockholder and received a dividend.
This is all correct so far, except like the companies that he was naming. I'm pretty sure Prudential is a stock company. I don't know if they used to be mutual and then demutualized, but his comparison here is correct. And when you're implementing the infinite banking concept, just switch this up a little bit. When you're implementing the infinite banking concept, you absolutely want to get your policy with a mutually owned company, because when you get your policy, you are now technically an owner of that company, which is one of the really awesome parts about this, guys, is that we are partnering up with these very financially sound, successful companies. They're the best in the world at risk management. These companies have been around for 100 years, 120 years, 150 years, have never, ever missed a dividend payment throughout all of the chaos over the last 100, 150 years. You got your Great Depression, the financial crisis of 2008, World War I, World War II, all these things that happen. But because they're so conservative with what they do within the company, they've always been able to pay a dividend to their policyholders. So, you do always want to go with a mutually owned life insurance company when you're setting these policies up.
Does that make sense?
Yep.
Now, follow the math here. If you are the owner of the company and you're also the customer of the company, and the only place the company gets money is from the customers that are owners, and they give you money from a profit, by definition, that means it's because they took too much from you as a customer. There wouldn't have been a profit otherwise.
That's stupid. That's so dumb. And later on in the video, he's gonna make a comparison about, like, I think it was Home Depot or something like that. But he's assuming that the only profit that companies make come from people who own whole life insurance policies. So they overcharge us, which that is partly true. Because whole life is a lot more expensive than term life, and so there is an overcharge for the insurance, but part of that is returned in the form of dividends. But that's where he stops. And he's basically trying to explain that that's the only that's the only way our policies grow. That's the only way that any profit is ever distributed, which is not true. The company sells just tons of different products that contribute to the profitability of the company. Not to mention that the premiums they take in, they also invest that in their general fund to create a very, very conservative portfolio that the average person just could never ever put together. But it typically generates that 4, 5, 6% every single year, and that's part of what helps cover death benefit claims and all that stuff. But it also contributes to the profitability of the company, which gets redistributed back to us as policyholders, since we're part owners in that company. So he's saying that every premium payment I make in my whole life insurance policy, the only way I get the dividend is by them overcharging me, and then they send that money back to me. That's a very small part of it, but you're not talking about all the other profit centers of the company, like term insurance. You want to talk about which Dave Ramsey is a huge fan of, tells you to buy term and invest the difference. You want to talk about a huge profit center for the life insurance company? It's term insurance. Now, it doesn't mean term insurance is bad. I'm saying I think it might be less than or like right around 1% of term life policies actually get paid out. That's because the actuaries know that based on all the data that they have, you're not likely going to pass away within the term of that policy. So you're going to pay all those premium payments to the company. And it's not like you didn't get you didn't pay for nothing. You were protecting your family during that time. But if they don't pay out the death benefit, they keep all your premiums. You basically just gave all that premium to the life insurance company. That's a profit center that gets redistributed back to the policyholders here. So there's a lot of different profit centers. It's not just me making a premium payment. They overcharge me and then they give me that money back. That it just doesn't make sense when we get to the next point here is when I stop making premium payments, which you can do. You don't have to pay into a whole life policy your whole life. You own it your whole life. It'll continue to grow for your whole life, but you don't have to make premium payments your entire life. So if I stop making premium payments, they're not overcharging me anymore. So why are they sending me money in the form of a dividend? Oh, wait a minute. That's right. Because that's not the only thing that's involved with the growth of the policy, with the dividends that get paid. See, guys, when we start to think about these things logically, we start to break down how these things actually work, this kind of stuff, it brushes off of you. It's just BS. Like, because he's only telling one small part of the story to make it sound bad so that you'll buy term insurance from his sponsor, which he's going to bring up here shortly. So, yeah, good stuff.
Okay.
So the IRS has deemed, consequently, that mutual life insurance company dividends are not dividends in the true sense of a dividend, that instead they are, and this is the IRS's language, they are instead a refund of a deliberate overcharge.
Correct.
So they overcharge you in order to give you some money later to make you feel like you're making money off of them.
That is the IRS definition, which is a good thing because that's part of what gives whole life insurance, dividend paying whole life insurance, its amazing tax advantages. So we want that definition. It just happens to be that there's more to it than just a return of premium because of the investments in the general fund, all the other different profit centers. But that is a good thing because that's part of what gives us these tax advantages in these policies.
And it's absolute hogwash. It's a pass-through. Mathematically, it's a pass-through. It's the way it has to be. It's the legal definition of the freaking company, and the IRS says so. So,
yeah.
Yeah.
The thing I didn't love is, when you take the money back, you basically are paying an interest rate on it. But
exactly. And whose money is this?
Right.
That you're borrowing your own money and you're paying them interest?
Yep. Okay. This is a fun one for me. Again, I did a whole training on this. I'll link it down in the description. Make sure you go through it on why it makes sense, why it's actually really smart to pay a little bit of interest to access the money and then go build wealth how you're going to. And the concept of paying interest to borrow your own money, you're not borrowing your own money. You're borrowing the life insurance company's money so that your cash value remains untouched and continues to get that 3 to 5% net compound tax-free growth every single year. It's a small price to pay to get that uninterrupted compound growth, access to the money, while I go over here and build wealth like I was planning on doing anyways. Whatever that means for you. For me, I do flipping equipment, very similar to flipping real estate. I'm going to be doing private money lending here really soon. All these different opportunities that I am accessing and taking advantage of by borrowing against my cash value, which I then use to make my investment over here. So I'm actually making money twice because I'm getting the uninterrupted compound growth tax-free over here in my policy, but now I'm making, maybe I make 12% on my private money loan, or I make 20% flipping the equipment, whatever that is. All of that profit pays for whatever interest that it costs me over here. Everything else is complete profit, plus my policy continue to grow at 3 to 5%. On what planet does that not make sense? Not to mention, so the other side of the argument that I get here sometimes is that you're borrowing at 5.5% and your policy is only earning 4%. Well, that's a scam. That's stupid. Why would you do that? The only reason you would say that is if you don't understand the difference between simple and compound interest. Guess what? Did a training on it. It's in the description. Where I actually ran real numbers. It took a real life scenario for me where I purchased a vehicle for $28,000. I put in an 8% interest rate, and then I compared it to what my policy would do at 4%. Typically nets 3 to 5%. So I just did the middle there. And believe it or not, guys, even with the interest rate being double on my loan, my policy still earned more money than what I paid into the loan, even though the interest rate was twice as much. Do you know why? Because in my policy, I'm getting compound interest. With the loan, I'm paying simple interest, meaning that interest is being applied to a lower and lower and lower balance over time, versus in my policy, that compound interest is being applied to a higher and higher and higher balance over time. That difference right there, like that, it just blew my mind when I started running numbers on that, and how I could take a policy loan for 8% and my policy can only earn 4%, and my policy will still come out ahead. I did the time frame I did was like 5 years. My policy earned $2 more than what I paid in that loan scenario, with double the interest rate, guys. It's just crazy how powerful compound interest is. When you understand that, these things start to make sense. And things like what Dave Ramsey is saying here, oh, you pay interest to borrow your own money? That's just stupid. That's a scam. No, it's not. It's such a powerful concept once you understand how to properly utilize it. If I borrow at 5.5% and I'm still getting the compound growth in my policy, and then I go over here and make 12%, what's the spread on that? Like, why on earth would I not do that over and over and over again? Like, it just doesn't make sense to me. But you have to understand how these things work and these basic financial principles in order for that to make sense. See, once I started to understand things like that, it just became this infinite banking concept, guys, became an absolutely no-brainer to me. So let's continue.
This is infinite banking for them.
Yeah.
Yeah, the infinite banking concept is old school, whole life, done poorly. You need a real financial advisor.
Now, what I will say really quick is when he says, hang on one second. I'm going to get a little more light in here, starting to get dark. So when he's talking about old school whole life, that is actually what Dave Ramsey is usually hitting on the most. The problem is he combines all types of whole life insurance. I mean, there's only one type of whole life insurance technically, but with whole life insurance policies, you can custom design and engineer them very specifically for your goals for high cash value and good long-term growth for a savings vehicle anyways. I mean, 3 to 5% tax-free compound growth in a savings vehicle is pretty darn good. But he's talking about 100% base policies. And I did more training on this. I've got a full breakdown of my own policy, guys, if you want to see how I set mine up. But when you set them up right, man, they can do really well, and they have a ton of benefits. But that is usually what he's talking about, is traditional whole life, 100% base policies, not set up for max cash value. That's usually what he's talking about. But that's not what we use for infinite banking, guys. So very big distinction there.
An insurance broker is trying to sell you a load of manure. And so, yeah, the other thing is that your cash values that are sitting there all die with you.
Nope.
So whatever cash you put into this is equals zero at your death, because they only pay.
Oh my God. This is like my least favorite argument against whole life. It's just so stupid. So let's break this down. Okay. This is the argument is the evil life insurance company keeps your cash value when you die. And like a lot of times too, what I'll get from people who hate whole life insurance is they'll try to ask me like that gotcha question, like, oh yeah, well, why don't you tell me what happens to the cash value when you pass away? Like, oh, I got him on this one. No, he didn't. When you just think about it logically and you understand the mechanics of how life insurance work, the cash value goes to your beneficiaries. It's part of the death benefit, guys. The death benefit grows with the cash value the entire life of the policy, number one. Number two, if you calculate the death benefit, what is the formula for it? It's cash value plus net amount at risk. That equals the death benefit. So here's what happens. And look, like I had somebody ask me, like, where's that in the contract? And what carrier you're talking about? I'm not talking about a specific carrier. Is it written in the contract that this is exactly how it works? No, because a life insurance company is not overcomplicating this like we are. This is the death benefit. This is the check that we are going to write to the beneficiary. That's it. Okay. But if we want to break down where that death benefit comes from, and you're going to sit here and say that they steal the cash value. Well, no, actually the cash value goes to the benefit. So when you pass away, here's how I'll explain it, is when you pass away, let's say I have $1 million in death benefit and I have $500,000 in cash value. Okay. So $500,000 in cash value, to get the net amount at risk, we're going to subtract the death benefit minus the cash value. Okay. That's going to equal the net amount at risk to the life insurance company. So here's what happens. When you pass away, The life insurance company is going to look at how much cash value you have. They're going to say, okay, we're going to give that to the beneficiaries. Plus, because we're on the hook for $1 million here, and he only has $500,000 in cash value, we need to add our $500,000 net amount at risk to this check, which equals $1 million, which equals the death benefit. So now, is it in the contract how that works? No, I'm just trying to explain how the mechanics of a death benefit or how a death benefit can be calculated is it's cash value plus net amount at risk equals the death benefit. So can't we argue that the beneficiaries actually get the cash value? And then the life insurance company adds more to that cash value, meaning it blossoms into the death benefit. Then it gets passed on income tax free because it's a death benefit from a life insurance contract. Guys, please drop some comments down below. Where am I wrong on that? No, it's not in the contract. Just stop bringing that up. It's not specifically written out that that's how it works, but that's how we can calculate it. It still comes out to the same number. So the life insurance company is not stealing your cash value. And here's an analogy I always like to give regarding this this part of the argument with this particular point is, let's say you have a house it's worth $300,000. Okay. And you have $150,000 in equity, meaning you still have a $150,000 mortgage. Okay. Let's say you sold the house tomorrow at $300,000. Would you really expect to get the $300,000 plus your $150,000 in equity? Or would you just get the equity? Yeah, you just get the equity. So why on planet Earth would you expect to get both the cash value, which is the equity in your life insurance contract, and the value of the contract, the home, which is the death benefit? Why would you expect to get both? It's literally the same exact thing. The equity in a home is the same exact thing as cash value in the life insurance contract. It represents how much you can borrow against, just like borrowing against the equity in your home equity line of credit, which actually that brings up another point I want to address here in a second, but let's finish this point. So equity in the property you can borrow against. Cash value, that's the equity in your contract, life insurance contract that you can borrow against. What's the other thing that cash value represents? It represents how much you would receive from the life insurance company if you canceled or surrendered the policy. Just like in a home sale, the equity is what you would receive if you sold the home. Same exact concept, guys, here, except life insurance is even better because as opposed to when you sell the home, you only get the equity. When you pass away, the life insurance company takes the equity that you have, adds the net amount at risk to that amount. That equals the death benefit. That's the check they cut to your beneficiaries, income tax free. Where does that not make sense? Please drop some comments down below. How is that wrong? That's how you can calculate where the death benefit goes, or how it's calculated. And so the argument that life insurance company keeps the cash value is absolutely ridiculous. The other thing, the last point I wanted to bring up that I forgot to mention with regards to paying interest on your own money, it's really funny to me how it's okay to do that in other scenarios, but not whole life insurance. So please explain to me the difference here. What is the difference between taking a policy loan, paying interest to the life insurance company, okay, and taking out a home equity line of credit that you now pay interest on? That equity is your money. Just like Dave would say, well, the cash value, that's your money. So you're paying interest to borrow your own money. Well, you do the same exact thing on a home equity line of credit, yet I never hear anybody say that that's a bad thing. Now, I don't know where Dave Ramsey stands on that. He's usually opposed to any kind of debt, but I don't know. I'd have to look at that. But how is it any different than taking out a home equity line of credit, paying interest to access your money inside of the property? What's the difference? But yet people do that all the time and have no issue with it. I rarely ever hear anybody say that that's a bad thing to do. Yet when it comes to whole life insurance, all of a sudden it's a scam. That just doesn't make sense. Really? At least be consistent with your argument if you're going to say stuff like this, because that's what misleads people, right? And leads to all the bad information that is out there. Like when you think about these things logically, you ask these questions, you make these comparisons, you learn how these things actually work. It actually does make a lot of sense. So anyways, let's continue. Let's have some fun.
Who does not have a policy? Northwestern Mutual does not have a policy that pays more than the face value, except universal life Bs, which are not in infinite banking products. And universal product B is where they charge more than they usually charge, which basically buys the insurance so they can still keep your money. Is the way the math actually works on this. So you're dealing with one of the most expensive insurance products in the marketplace. If you're dealing with either one of those two companies, I would stay completely away from both of them. They're everyone in the financial field except people that work for them, we all think they're a joke.
I don't care, because I think you're a joke. You know, the joke's on you, pal. All of the terrible information that you're providing about this product is sad, and it's hurting people. You know, you're giving bad information that causes people to make decisions that are not in their best interest because it's bad information. The joke is on you.
Anyone who's academically trained or has any kind of CFP or anything else, when someone says they work for Northwestern Mutual, we just kind of laugh and go, yeah, right, you screw people every day.
Really? I mean, you're screwing people every single day with this awful information that you're providing.
So, dude, you need to get away from them, and you need to go get a real financial advisor that can help you do some real investing that takes into consideration your low risk tolerance. Low risk tolerance does not need to lead you to losing your money, 100% of the cash invested at death.
Yeah, you don't. It's part of the death benefit.
That's a bad risk tolerance thing. So you need to move on, dude. You need to move on. Because the whole thing of the dividends are paying for it is such a joke, because the dividends are the refund of a deliberate...
This is where he goes into the Home Depot analogy. This is going to be really good.
Overcharge. So who's paying for it? If you were getting dividends if you own Home Depot stock and you got dividends from that, then Home Depot's making a profit, but they're making a profit off of their customers.
Yes.
And I'm the owner of the investment. I get that dividend. That's different than if I am the customer and I'm the stockholder. Thereby, the only way I made a profit was off of me.
That's so stupid, guys. Just think about this logically for a second. Basically, what he's saying, he's making the comparison that with whole life insurance, that the owners of Home Depot are the only ones that shop at Home Depot. Therefore, and the comparison he's making is that the only profit that comes from these dividends and whole life insurance is whole life insurance policyholders. That is absolutely ridiculous. Life insurance companies sell tons of products to all different kinds of customers that contribute to the profitability of the company, not to mention the general fund that they have where they invest those premiums. They earn that 4%, 5%, 6%. That's part of the profit that gets returned to policyholders. And like I said before, you know what a major profit center is for a life insurance company, which these people do not receive dividends, is term life insurance policyholders. Not a bad thing. Not saying not to have term life insurance. That is people who purchase term life policies are customers of the life insurance company, which contributes to the profitability, which contributes to the dividend that we receive as whole life policy holders. Oh my God. That's a nice try, but that doesn't work. Sorry. All right, let's finish up.
Myself.
So I pay you an extra $100 and then you give me 70 of it, and I'm supposed to feel great about that.
Right. Yeah.
So that's what this amounts to.
God,
and so you guys are working with State Farm, when you get your little dividend check, that's what it is. It's the refund of a deliberate overcharge. IRS verbatim says that.
Yeah.
And that's why you don't get taxed on it. If you get a dividend on Home Depot stock, you get taxed on it as income because it's real income.
All right, sorry. Pause it really quick to turn my light on. It's getting dark outside. Actually, I want to back up here for just a second because I do want to address this part where he's talking about the tax situation.
On Home Depot stock, you get taxed on it as income because it's real income.
He's saying that like it's a good thing. I don't know about you, but I don't want to pay taxes. Now, that doesn't mean don't buy and invest in dividend-paying stock just because you'd pay taxes, or not to do this investment just because of taxes. But this comparison is ridiculous because one of the great benefits of dividend-paying whole life insurance is the tax advantages. So when I'm 75, 80 years old, by the time my policy has had a lot of time to grow, I've put a lot of money into it. It's getting really good compound growth. My dividend might be $40,000, $50,000, $60,000 a year, which I can then switch to paid in cash and get a tax-free dividend from the company up until my principal amount tax-free. How is that bad? Just because it's not what he calls taxable income. Well, that's a good thing. We want to reduce the amount of taxes that we pay. We don't want to be proud of all the taxes that we pay. At least I don't.
You really made an investment, and then you really made an income. So that's what's going on with that stuff.
That doesn't make dividend-paying whole life insurance bad. Like, you can do your investments and you can have a dividend-paying whole life insurance contract as well. So, you know, that's just kind of a stupid comparison in my opinion.
And so do not buy anything in the life insurance world based on dividends. You look at the price. Look at the
Don't buy anything based on what Dave Ramsey says. Not literally. I'm just I'm being facetious here at this point. But you know, this is just really frustrating stuff. I think this is where he's going to promote his sponsor right here.
Structure of the policy, and you'll usually find that mutual companies, by the way, are the higher priced.
Yeah.
So when you go to a quote service like a Xander Insurance and you get quoted on term life insurance,
which I believe he does sponsor, and not that that's a bad thing. I'm not hating on him for that. But what I have a problem with is when he's talking about how terrible whole life insurance is to make the term insurance that his sponsor sells sound so much better. That's wrong. You're screwing people over. You're hurting people because you're providing wrong, just terrible information that influences their decisions, that influences decisions that might not be in their best interest. That's what I really have a problem with.
You're going to find no mutual companies in the 42 different companies that they give you a quote from because they're not competitive.
I'm pretty sure that's not true as well. I got to confirm this. I've watched other influencers, or just other people that have done review videos on this particular video. They search, and there are mutual companies on that site. I don't think it's a big deal, you know, but just keep that in mind.
Why? Because they charge more, so they can give some of it to you back later and make you feel like that you got something. That's really what it amounts to, and that's why you won't find them. They're not competitive.
All right, we'll go ahead and wrap up with that. I think those were the main things that he brought up about infinite banking and whole life insurance that are just absolutely ridiculous. So I hope that was helpful, guys. I hope it just brings a little bit of clarity to the conversation and gives you some things to research. Right? Don't take my word for this. Don't take Dave Ramsey's word for this. Take this stuff and use it to analyze these different products and just learn how these things actually work so you can make the best decision for you. Don't take what one person says at face value just because they seem like an authority figure and they know what they're talking about, or they're what do you say, academically trained, and they got all these fancy titles and stuff. Not that those are bad, and you know, I'm sure there's plenty of people with those titles that are great. But don't just take their word for it. Do your research on these things, because we're talking about potentially life-changing financial decisions here. We need to take this very seriously before you do anything. You need to understand how these things work so you know that you're making the best decision for you. All right. So anyways, let me know if you guys have questions. Drop some comments down below. I'd love to hear your feedback. I'm sure it's going to be an interesting conversation in the comment section as we progress here. But, make sure you check out all the additional training in the description. I go into more detail about some of these topics. Got a free masterclass, university, all that good stuff about infinite banking, and just sharing my journey on how I'm using this incredibly powerful financial concept, guys. It's just awesome. So anyways, hope you're crushing it, and I'll talk to you in the next one. To your success, Matty Ice is out.